we look at June in isolation, very strong month in the US equities markets, with US returns up in the order of sort of 4 to 5% for the month. A bit of a slower month here in Australia, up sort of 1.5 or so percent across most equity markets. Relatively flat across most fixed interest markets. Cash rates remained relatively flat through the period as well, so I don't think there was any RBA meetings to talk to. That'll come through in this month. Clearly intra-month there were some issues which cropped up, which added a little bit of volatility in discrete markets, and energy was one of those, with the escalation intentions and the involvement of the US with what was going on with Israel and Iran. It's been quite a volatile period for markets generally. We've had Trump come into control in the US. We've had the announcements of tariffs and the backtracking of what those announcements were, which was an interesting dynamic. We've then had other geopolitical tensions escalate through what's going on through the Middle East, and then finalising with the brief, quite traumatic and dramatic issues that went through in Iran through June. Having said all that, if you look at the quarter, had quite robust returns in equity markets. I think if you look at the quarter and the timing of that, so April was the starting point, so that was when the tariffs were being introduced and announced. So there was a bit of a pullback in markets at that time in anticipation of those tariffs, and clearly that added a lot of volatility into equity, currency and fixed interest markets at that point in time. If you then take a bit of a wider lens and look at the 6 months to date, so for January through to June, markets have been positive and relatively positive across most asset classes. If you look at some of the different charts, so that there's some political uncertainty, and that there leads to concerns or questions as to what do you do? You know, what if you're trying to consider what you do as a strategy as a business? Do you invest and do you build new facilities? Do you do that onshore or offshore? And making decisions probably for at least a 3-year horizon, if not longer. And so while there's uncertainty with policy, businesses begin to pause. You know, they question what they're doing and how they invest and what they're doing with money that they were looking to do something for the future for their business. And so with that uncertainty, that causes some concerns around, you know, if people aren't investing, what does that mean for job markets? What does that mean for inflation and the likelihood of increases in wages? Obviously that flows into interest rates, and that's a different decision-making process with the policymakers that consider the relevant data points for those being largely unemployment and inflation. So, you know, that's the cycle of the economy. That's the cycle of how markets all come together. It's very, very complex. Trying to distill it in simple terms through these updates, but you know, clearly it's the uncertainty that creates the volatility and pausing on decision making with what goes on with the future. Yeah, so if we extend the 6-month period to other markets, so if you look at cash rates, the US cash rate started at 4.5% and ended at 4.5%, so no change there to the frustration of the president in the US. That's something clearly that will be continuing to look at or be in the headlines, I think, as we move ahead, with the presumption that rates should be lower in some camps, whereas I think the governors and the others that are in control of decision making there will probably sit on their hands until they get greater information around what the data looks like. So still concerns over inflation and the inflationary impacts of the tariffs that have been announced. If they do come into force, they're likely to flow through to consumer prices, and it's an uncertainty, as we say. So that's one where the Fed chair is likely to pause, and until there's certainty and direction, they're probably likely to retain rates where they are. For the outlook, there is still markets of the view that there's likely to be a couple of rate cuts in the US. Flip to Australia, so the interest rates here started at 4.35% and now down to 3.85% in the 6 months. So the RBA's met and agreed that the conditions are heading in the direction that they were comfortable with in terms of inflation, and that wage prices or wage inflation wasn't getting out of control either. And so 50 basis points of cuts so far. The very recent inflation data point that came through just in the last week suggests that there's probably continual expectations for further rate cuts. If you look at currency markets, it's very difficult to predict, as we've written an article, which for those of you that get the newsletter, you can read about that. They've been volatile, as you'd expect, and some of the explanation of that for Australian residents and investors is, we're a risk-off currency, so when there's uncertainty in markets, generally the Aussie dollar weakens. Having said that, probably from the start to where we are today, it's been relatively flat. And it's had different outcomes through different currency pairs as well. So it's been stronger against the US, and I think that's probably a bigger story around the change of US exceptionalism in inverted commas, and that sort of starting to wane a little bit as we've had all this uncertainty come through from the tariffs and other implications in the US, and what the sustainability of their fiscal or debt position is over the foreseeable future. And it's been a little weaker against other currencies, against the likes of the yen, the euro, and a few others, it's been a little bit weaker. And that's probably the interrelationship that we have with China. Still a few concerns around the growth profile of the Chinese economy and the consumer in China, which Australia is still seen to be quite closely tied to. Yes, we've had volatility, but the results in this last 12 months, the last 6 months, have been quite strong. And so, looking at returns for fixed interest assets in the order of 6 to 7%, which is better than what you would get from looking just at the headline yields. So that's a little bit of capital improvement on those values as interest rates have started to fall away, only fractionally, but it does make a difference. And equity markets have been very robust in terms of the point-to-point 12-month period, where you'd be looking at anything in the order of sort of 10 or 11% for more higher risk parts of the market, which is probably not what you'd expect. You'd expect them to be at the higher end of the return profile. But the large and mega cap businesses are still in focus and still seen thematically as being those winners and those that will continue to reap the rewards of the AI and other technology trends. So there's short-term issues that impact markets which create the volatility, but those long-term thematics of the AI and technology winners, of the demographic changes that you might see, of the debt profiles that are in markets, they're the things that you need to be mindful of and focused on over the longer term. The core theme absolutely is focusing on the long term and not jumping at near-term movements on markets. So yes, it's quite challenging to take your behaviours and try to avoid the headlines and put the papers down when there are challenges that are in the world. But from an investment perspective, you've got to take a long-term view. You've got to allow investments, you've got to allow markets, whether that's companies that you might be buying, whether that's fixed interest securities that you might be lending to someone. You've got to think of the long term and how those trends or how those positions play properly into your portfolio over the longer term, rather than trying to predict short-term movements that are really quite difficult to do over the near term.